Picture this, mate. You're sitting at the kitchen table with two bits of paper in front of you. One says fixed for 3 years, the other says variable, and it could change as soon as next month. You've got about 20 minutes before your mortgage broker rings back, and somehow this one decision is going to affect your finances for the next few years. Sound familiar? That's exactly the spot a lot of Australians find themselves in. So in this video, we're going to cut through all the jargon and look at how fixed and variable home loans actually work, what they can really end up costing you, and how to work out which one is more likely to leave more money in your pocket. Just quickly though, any dollar figures I mention are simply examples to help explain the concepts. They're not current market rates. Now before we get into all the comparisons, let's make sure we're on the same page, because this is where a lot of people get tripped up. A fixed-rate home loan does exactly what the name suggests. It locks in your interest rate for a set period, usually somewhere between 1 and 5 years here in Australia. If you've got a standard principal and interest loan, your required repayments will generally stay the same for that entire fixed period, which makes budgeting a whole lot easier. A variable loan works differently. The interest rate can move over time. If the Reserve Bank changes the cash rate, your lender may increase or decrease your rate as well, although they're not required to pass on every change in full. And here's the important bit, mate, neither option is automatically better than the other. They're simply designed for different situations, and choosing the right one comes down to understanding which situation you're actually in. Here's something most people never really hear explained properly. Fixed rates aren't decided only by where everyone thinks interest rates are heading. That's definitely part of it, but banks are also looking at things like their own funding costs, competition from other lenders, credit risk, and of course their own profit margins. So if the market expects interest rates to come down over the next few years, you might actually see fixed rates sitting lower than variable rates because the bank is pricing in what it expects to happen across the whole fixed term. On the other hand, if rates are expected to rise, fixed rates are often higher from day one because the bank is protecting itself against those future increases. Put simply, when you choose fixed, you're usually paying for certainty. So what is that certainty actually worth? Well, let's say you're offered a fixed rate that's a little lower than today's variable rate. On a $600,000 loan over 30 years, your repayments could stay exactly the same for the next 36 months. It doesn't matter if inflation surprises everyone, it doesn't matter what the RBA announces next month, and it doesn't matter what the headlines are saying. Your repayment stays exactly where it is. For plenty of Australians, especially anyone who's been through a period of rising interest rates before, that peace of mind is worth a lot. You know exactly what's coming out of your bank account every month, and that makes planning the rest of your finances a whole lot less stressful. Now compare that to a variable loan. You might start off with repayments that are a little higher than the fixed option, but here's where things get interesting. If the RBA decides to cut the cash rate over the next year, and your lender passes most or all of that cut on, your repayments could start coming down. Before long, you might actually be paying less each month than someone who locked in a fixed rate. Of course, the flip side is just as real. If rates head higher instead, your repayments can climb with them. So with a variable loan, you get the chance to benefit if rates fall, but you also wear the risk if they go the other way. And honestly, mate, that's the part a lot of people underestimate. It's easy to think you'll be fine with higher repayments until they're actually coming out of your own bank account every month. And here's the twist that catches plenty of borrowers out. The cheapest loan today isn't always the loan that ends up costing you the least over the next 3 years. What matters isn't just the rate you're offered today, it's what happens after you sign the paperwork. Let's say the RBA cuts interest rates a couple of times over the next 18 months, and lenders pass most of those cuts on. If you're on a variable loan, there's a good chance your repayments will gradually come down as well. But if you fixed your rate for 3 years, you're locked into that rate the whole time. You'll be watching other borrowers enjoy lower repayments while yours stay exactly the same. You could break your fixed loan and refinance, but that can come with break costs. Depending on your lender, how much time is left on the fixed term, the size of your loan, and how far interest rates have moved, those costs can be anything from very small to several $1,000s or even more in some cases. It's not guaranteed, but it's definitely something you want to understand before locking yourself into a fixed rate. Now let's flip the situation completely. Imagine rates start rising instead. If you're on a variable loan, your repayments can keep creeping up, and sometimes that can mean hundreds of extra dollars every month. For households already stretching the budget, that can put some real pressure on day-to-day finances. Meanwhile, the person who fixed their rate is still paying exactly what they agreed to from the start. Their repayments don't change just because the market does. That's why during periods of rising interest rates, fixed-rate borrowers often sleep a little easier, while variable-rate borrowers are paying much closer attention every time the RBA announces its latest cash rate decision. And that's really what this decision comes down to, mate. It's not about which loan is better overall. It's about which risk you're more comfortable taking. With a variable loan, you're accepting that rates could go down, stay about the same, or climb higher. With a fixed loan, you're choosing certainty, even if that certainty doesn't end up being the absolute cheapest option in hindsight. Neither choice is wrong. The real mistake is picking one without properly understanding the trade-offs you're making. Now there's another piece of the puzzle that doesn't get talked about nearly enough, and that's flexibility. See, a lot of variable home loans in Australia let you make unlimited extra repayments, and many of them also come with an offset account. If you're not familiar with how an offset works, it's basically a savings account linked to your mortgage. The money sitting in that account is offset against your loan balance, so you're only charged interest on the difference. That can save you a surprising amount over time, although the exact features depend on the lender and the loan you've chosen. Fixed loans, on the other hand, are usually a bit more restrictive. Most lenders put a cap on how much extra you can repay each year, often somewhere between $10,000 and $30,000. Go over that limit and you could end up paying break-related costs even if you're not actually ending the loan. So if you're the sort of person who likes throwing tax refunds, work bonuses, or any extra cash straight onto the mortgage, or you plan on using an offset account as part of your savings strategy, a fully fixed loan might end up feeling a lot more limiting than you expected. And that's exactly why so many Australians don't actually choose one or the other. Instead, they go with what's called a split loan. It's pretty much what it sounds like. You split your mortgage into two parts. Maybe 60% is fixed, while the remaining 40% stays variable. That way you've got the certainty of knowing a big chunk of your repayments won't change while still keeping the flexibility that comes with a variable loan. Just keep in mind that with some lenders, the offset account only applies to the variable portion of the loan, so it's always worth checking the fine print before signing anything. Is it the perfect solution? Not necessarily. But for a lot of borrowers, it's a really sensible middle ground because you're not putting the entire mortgage on one outcome. Timing is another area where people often get caught out. Plenty of borrowers try to guess exactly where interest rates are heading, hoping they'll lock in at the perfect moment or stay variable until rates hit the bottom. The problem is that's incredibly difficult to do. Even professional economists, whose job is to forecast interest rates, get it wrong on a regular basis. So instead of asking yourself whether rates are about to go up or down, a much better question is this: if repayments increased more than you expected, could your budget comfortably handle it? If the honest answer is no, then paying a little extra for certainty might actually be worth it. On the other hand, if you've got a healthy financial buffer and repayment changes aren't going to cause you much stress, staying variable becomes a much easier decision because you've got room to ride out whatever the market throws at you. Here's something that really puts the whole decision into perspective. Over the life of a home loan, the difference between taking a fixed path and a variable path can add up to many thousands of dollars, depending on how interest rates move over the years. That's not pocket change. That could be a family holiday, a decent chunk towards your next car, or a big boost to your emergency fund. And what's interesting is that it all comes back to one decision you made when you first signed your mortgage documents, combined with something none of us can fully control, where interest rates end up going afterwards. So how do you actually make the call? Well, the first thing I'd look at isn't the headline interest rate, it's your own situation. Ask yourself how much risk you're genuinely comfortable taking. If a decent jump in your monthly repayments would put real pressure on your household budget, then a fixed rate could give you the certainty and peace of mind you're after, even if it doesn't end up being the cheapest option in hindsight. On the other hand, if you've got a bit of breathing room financially, you're comfortable with repayments moving up and down, and flexibility is important to you, then a variable loan could make a lot of sense. And if you're sitting there thinking, honestly, I still can't decide, that's perfectly normal. In fact, that's often a good sign that a split loan might be the best fit because it lets you spread the risk instead of putting all your eggs in one basket. There's one last thing that's worth keeping in mind before you sign on the dotted line. Whatever you choose today doesn't have to be forever. Australians refinance their home loans all the time. Maybe your fixed term comes to an end and there's a much better deal available somewhere else. Or maybe you've been on a variable rate for a while and your lender is no longer competitive. Refinancing can absolutely be an option. Just remember, it's not always free or automatically worthwhile. You'll usually need to meet the new lender's eligibility requirements, and depending on the situation, there can be application fees, discharge fees, or other costs involved. So before making the switch, make sure you actually run the numbers and check that you're coming out ahead. At the end of the day, mate, there isn't a universally right answer when it comes to fixed versus variable home loans. It really comes down to what suits you. You're balancing certainty against potential savings and flexibility against the possibility of repayments going up. Once you understand exactly what you're trading off, the decision becomes a whole lot clearer because you're making it based on your own circumstances, not just on whatever interest rate happens to look best today. Just before we wrap up, remember this video is general information only and isn't personal financial advice. Everyone's situation is different, so if you're unsure which option is right for you, it's always worth having a chat with a licensed mortgage broker or a qualified financial advisor who can look at your circumstances properly. If you found this video helpful, give it a like. It really helps more Aussies find this kind of content. And if you're not subscribed yet, make sure you hit that subscribe button and turn on notifications, because we've got plenty more videos coming that break down Australian money, mortgages, and personal finance in a way that actually makes sense. Thanks for watching, and I'll catch you in the next one.